What is up, everybody? In this video, I'm gonna share with you how to understand options because, well, fuck, every video out there is so fucking confusing. I've been fucking with options for a few years now. I understand them, okay? Am I qualified to make this fucking video? Probably not, but guess what? I'm making it anyways. So, for those of you who've not watched this video, how to read a DOM, you don't know anything about the DOM, you should go watch this video because understanding the order flow on the DOM is going to be crucial for this video. That's right. You need to know a little thing or two about order flow because that's going to help us understand the options chain when we take a look at it. And I'm going to help you understand the basics of options and how they work, how they're different, how I use them. And this ain't like any other damn option video out there. Between you and me, a lot of these option traders out there, it's funny when I watch their YouTube channels and then they go from trading options for years to try to trade future outrights. They fucking suck. No offense, guys. And I'm probably gonna piss off some of the option community in this video, but you know what? That's what I do. I rub you guys the wrong way sometimes. Just understand that these are my own ignorant opinions on options. No, it's gonna be good if you just pay attention. You're gonna learn a thing or two. We're gonna learn the basics of how long calls, short calls, long puts, short puts work, the option chain, because I think a lot of options educations out there don't go over the option chain enough to help you understand what's really happening. Once I started to learn the option chain, I'm like, okay, this shit makes sense. Use the description below to jump the chapters if need be. Other than that, man, my throat's getting dry. This is what, the tap water looks like in my place. Should I drink that? You think that's healthy? Fuck it. Ooh, look at all that sediment. Ooh, wee! You know what we need? God dang. You know what we need to do? We're gonna light an incense. We're gonna light an incense to cleanse my freaking soul after I drink that. Whatever the fuck that was. Alright? So I'm gonna do it on the floor here. Yes. I'm actually going to do a newer Cult of Cat episode. If you've not seen my other channel, Cult of Cat, it really has nothing to do with trading, but if you like this wacky character named Fat Cat, where I talk about law of attraction, and I'm actually going to be talking about anchoring in the next episode. I drink wine now. That's another channel of mine. Whatever, you know, it's entertainment. It's a good fucking time. Here, I gotta do business. Alright, get to the point, Fat Cat. Okay, fucking calm the fuck down. Alright, ladies and gentlemen, this is an option chain, and this is going to be for the SPX. Which, this is basically the ESE mini for my futures people out there. Hey, and if this is your first time checking out my channel, this channel is mostly dedicated to futures trading. So those of you who understand futures trading, the SPX, this is going to be the option chain for the SPX. All right, I'm gonna make it simple. So these are expirations. Now the big thing right now is these 0-day DTE option strategies. We're not gonna be talking about any of that shit, but these are the expirations. These things I'm probably fucking up, but if I remember correctly, SPX options and even SPY, if I'm not mistaken. SPY is a little cheaper than SPX options, but they both track the ESE Mini or the S&P 500, if you want to be politically correct here. These are what day these damn things are going to expire. This says 19 days. This says 18, 17. So it's like every other day these things expire. Now, those of you who understand futures contracts also expire. The ESE Mini expires every quarter, but there's a difference here. Options expire worthless. They were shit when you get to zero, okay? But a futures contract, the contract, yes, it expires, but it doesn't expire worthless. It doesn't go to zero. So why is this shit going to zero? Why has this become a worthless heaping pile of nothingness at the end of its expiration? This is where the DOM comes into play. Now, as far as choosing expiration dates, which one should I choose, Fat Cat? Just chill, okay? We'll just go to this one, Tinge, all right? So when you click on it, this is Tastyworks, by the way. To be honest with you, I think their platforms kind of sucks. It's not good for somebody like me. I believe with Thinkorswim, you can get an actual market depth on this. I'll talk about it later. But, yeah, we'll just click on this 19. Fuck. We'll click on this. You click on one of these boxes and then it expands it. Okay, you click on it again, it goes back. I said when you click on it, it goes back down to nothing. Right? Then you get to choose. So, and boom, it explodes. So you're opening the window when you click on the expiration. So currently, this orange line is where we're... Welcome to the land of backwards, by the way, guys. Currently, the orange line is where the market is trading. So SPX trades in multiples of 5s, right? You got 4,100, 05, 10, 15, 20, 25, 30, 35, 40. Let's look at a normal fucking chart on Sierra. So we closed, I don't remember where we fucking closed at. We closed about 41.90.75. Pull this back up. This should be, well, you know what? You know what happened? This is still weekend, guys. These damn options stopped trading, at 4 p.m. New York City time, whatever that is, Eastern. So we was at like 41.75, 41.65. I'm filming this on a freaking Saturday. Yeah, so this is saying we're at 190. So the overnight session is trading 41.90. All right, I know that might be confusing. So hypothetically, we're here. But the way the option shut down, it says we're at 165. If this was open, if the market was open, it would be over here. It would be trading right up in this section, okay? So this orange line is telling you where the market is going. And this is why I said land the backwards. Because the prices go up as you go down the option chain. And the prices go lower as you go up it. It's like it's fucking upside down. So there's the first difference between a DOM. God dang, do you remember when it used to be this thick? This is very old, actually. The ES is not this thick anymore on the book. I'll move it over here. But on the ES, the price goes up. You can see like 18 is up here, 19, and then 15 is down here. You know, so on a normal depth of market or whatever, or even a chart, the price is going up as it goes to the upper side of your fucking computer monitor. Makes sense, but for some fucking reason, the option guy, whoever these people are, made it go down. Okay, so just understand that this is, when you see this orange bar doesn't really move. What happens is it stays there, and all these prices behind it sort of move up, I think. Fuck. I don't remember. Either way, this orange bar is usually just always in the center of the damn thing. I mean, you could scroll up and down. Look, yeah. So you can scroll up and down. There's the other option chains right there. So yeah, that's what happens, is this orange bar is moving up and down with the actual price. Okay. I swear to fuck I know what I'm doing here. So now we're gonna kind of just look at this side. This side is the calls. This side is the puts. So the thing is, we're not gonna look at the put side. Don't even look, pretend like all that shit on the right side doesn't exist. I know all these numbers are fucking with your head. Don't worry about the Greeks. Fuck the Greeks, okay? Fuck the Greeks. It doesn't matter to understand how this works. So we're gonna pretend like we're buying this shit, and the market is open right now, okay? We're gonna use our imaginations and pretend we're trading at 41, 65 right now. We're trading between these two. Okay, so all these little numbers right here, they're going to be going up and down. You're going to see them turning green and red because they're going to be going up and down. So these numbers right here, this is the bid, this is the offer. Maybe I should probably fucking zoom in. Okay, so this 42.80 and 45 right here. Okay, this is the same thing as, this is why I said you need to watch this video here. It is literally the same thing as this, right? So that right here, this 1675 by 17, this 522 you're sitting here is the offer. It is the same thing as this 45, okay? Same thing with this 388 on the DOM. Okay, I know you probably didn't see that. So that 522 right there, that's an offer. This is the offer right here. Okay, and then over here, this bid at 1675 with 388 contracts sitting there, that's the same thing as this 4280. Okay, but the difference here is there's not 4280 contracts sitting there. Okay, that is the price of what this is. So you're paying 42. So if I want to join the bid right here, right? If we're trading a normal DOM, you've guys seen my videos. You click on that empty cell. If I'm trading a one lot, that 388 goes up to 389. And then I'm waiting in the queue to get filled. Same thing happens if I click on this 4280. Okay, I'm going to put into a queue. I'm going to be sitting in a limit bid. Same thing. The difference is this 4280, that's the price. I'm actually going to be paying, and you got to times it by 100 because one option contract is worth whatever you're trading, whether it's stock or SPX times 100. So let's pull up our calculator. So 4280, again, remember these numbers are going to be going up and down throughout the session. 4280 times 100. So that's $4,280. I'm going to be paying $4,280. Listen, guys, if you're trading SPY, it's a lot cheaper than SPX. Just so you know. The reason we're using SPX is because the numbers, the price in the middle right here is the same as it is on the ES charts and shit. So that's why I'm using it. So just remove the decimal. That's what you're paying for it. So you're paying $4,280. Or I could use a market order and buy it at $4,500, right? So clearly there's a spread. Whereas if you're looking at a DOM, the bid offer is as tight as possible. So let's take a look at the actual spread here. So 45 minus 42.80, that's a $2.20 something cent spread. So that's a big ass spread. Again, it might be tighter when the market is open. So that's kind of like the equivalent of the offer. Like there's nothing here on this DOM, right? Pretend there's nothing here on this DOM. That's like the offer is up here, way up there, and the bid is way down here, and there's nothing in between. That's a spready market. Stocks, penny stocks, crypto, they get real spready, whereas futures, the bid and offer tend to always meet, and they're always one tick above each other. Not on options. And again, this isn't your Q position. This is what you're actually paying for this shit. It's still a bid, but I'm paying $4,280 versus 45. Now, this isn't market depth going up or down right here, okay? What you need to do is you need to pretend each one of these prices are its own market, right? In futures, you have the ES, E-minis, you have NQ, you have crude, you have bonds, you have hog futures, you have fucking gold, right? Those are all different products, right? And they all have their own different depths of market, correct? Correct. Okay. So what you need to do is pretend that each one of these prices is its own product. So 165 right here is ES. 160 is gold. 155 is bonds. 170 is Bitcoin futures, whatever. Or you could think of it from the perspective of like Pfizer or American Airlines or Clorox or Home Depot. each one of these prices is a different fucking product. Okay? Just understand that. But instead of it being named Clorox, American Airlines, or whatever, or ESE Mini, the product's name is the price. Okay? So I'm trading the strike price of 165. I'm trying to put a call on 165. So unfortunately, I can't show you this because Tastyworks doesn't do this, but on other platforms, and I believe Thinkorswim, you can get access to level 2 data. Level 2 data is basically what you see on my DOM, where you can see the actual market depth. Meaning I can see the bids and offers all down here. I can see all these bids, and then I can see all the offers right there. Okay? So right here above this 45, there's going to be a bunch of offers. Okay? And then right below this bid of 42.80 is going to be a bunch of bids. Again, these numbers up here are like their own DOM. So the price of 160 has its own depth of market like this. The price of 155 also has its own depth of market. So let me show you. So what I can do is, this is me essentially attempting to sell. And what I need to do is zoom out a bit. Okay, I zoomed out. So right here, this is me trying to buy it, or this is me trying to sell it. Sell one, buy. Okay, this is... I got a lot to say about this. Okay, so they're saying, hey, you can buy it at 45 even. You can buy it at 45 even. Well, that's me hitting a mark, because the offer's at 45 even. That's like me submitting a market order, right? So here's the deal. Let me pull up the damn DOM again. So this is why I told you guys to watch this. See this blue 89 right here? That's a market order, okay? That, if I was to submit at 45, then I would be submitting a market order. So I'm hitting the offer. Well, there's a problem here. That's a $2.20 fucking spread. That's huge. That's huge. Okay? Whereas I can do this and try to join the bid. So what I can do is I can slide this fucking thing over to 42.80 and I can join this bid right here. But remember I said there's a huge spread? Remember I said there's a $2.20 spread? So that's like this DOM not having fucking jack fucking shit in here, right? So pretend this is where the best offer is, where this 488 is and this 388. Well, hypothetically, since there's nothing there, I could put a limit. I could put a limit sell right here, or I could put a limit buy here. Hell, I could even put a limit buy right here. So, and that's where somebody else has their order, where that 4280 is. That's where the best limit order is. So what I could do is try to front run them by pressing this up arrow. And this trades in 10-cent increments. So what I could do is submit an order at 4280. If I submit an order at 4280, you'll see this go, 4290, sorry guys. If I submit my limit order buy, because it's green, at 4290, you'll see this go to 4290. That means the best bid right now is at 4290. Okay? Same thing if I switch to a sell. Look, they saying, hey, do you want to market sell into 4280? Fuck no, it's a $2.20 fucking spread. I mean, really, it's up to you guys if you want to do that. But see, any of these prices here, I could try to join 45 even, but I would be in a queue. I wouldn't be the first position in the queue. Or I could submit 4490 on the sell side, and if I submit that order, you'll see this drop to 4490, okay? So really, I could put it anywhere in between. This right here is called the mid price. So, right here's the mid. You can see how it says mid. Options always have these spreads, right? So this would be the best price. It's not the best price. This is the price directly in between 42.80 and 45. So if I submit a limit buy at 43.90, this goes to 43.90. So that mid price is, remember, you got to spread on the DOM. It is right in the middle. It is the price directly in between the offer and the limit bids. So that's the mid. So if you don't want to market order in and get a shitty fucking fill, you don't want to market order in on a $2.20 spread. I mean, fuck, dude. If you got to break even, you're losing $220 instantaneously. That's why big spreads aren't good. That's why futures are great, because the spreads are tight. Tight spreads, woo, girl, those are nice. Okay, so that's how that works. Unfortunately, and then I can delete the leg. Okay, unfortunately, what we can't see is my queue position. Now, I believe on other platforms you can, and what we also can't see is level 2 data. We cannot see these bids, and we can't see these offers, and we can't see how many people are waiting in each of these prices. Okay, we simply can't see that. Now, again, other platforms you can, but Tastyworks is giving me top of book data. It's no different. Like, I see guys who trade DOMs on YouTube videos, and they're using literally top of book data because they have no idea what they're fucking doing. Basically, it would show you that 522 and that 388, but you wouldn't see any of the numbers above or below. And as the price is moving up and down, you just see this bid and offer. That's it. So that's what's happening here. Also, unlike our depth of market, it's not staggered. They're side by side. But check this out. So if I want to join that bid, I could join the 42.80, or I can press this down arrow, right the fuck here. Right there. And look, I can join 42.70. I could join 42.60. I could go all the way down. I could go to 41.90, baby. Right? Hell, I could go, okay, look. I could even type something in. Okay, let's type something in, fat cat. I could type in the price of 39.80. Okay? That's really far away, but I could type in 39.80. Do you know where else there's a bid of 39.80? Right here at the 41.70. But again, that's a different product with its own depth of market. So if I put in 39.80 right here, I'm not joining the 41.70 strike. Okay, remember, this is ES up here. This is like crude at 41.70. I ain't trading crude. I'm trading ES, baby. So I'm trading 41.65. Just because this bid is the same price as the bid at a different strike doesn't mean I'm trading 41.70. Fuck no. Okay, again, I hope you guys understand what I'm saying here. I don't know if I can explain this any more than this, but that's how this option chain works. Whatever price I'm trading, that's the price I'm trading, okay? Whereas this 30... I don't remember what we was talking about. I was hacking up a fucking lung, because all that smoke is going in my throat. But it's cleansing me. Okay, again, this is a different product, okay? So just understand that there is actual market depth. You're actually waiting in a queue on a limit order. The way these chains work, it works just like futures. The way it has market orders, it has limit orders. Again, that's why you guys need to go watch that video. What video? This one! So again, there's limit orders and market orders, and you can even see it right here, down here. It says, what order type would you like to send? Market order. And then if I hit market order, it's going to hit that 45. Not a good idea because the spread is, or I could go limit. But if I submit this limit order, it's like I got to go in as a market order, for fuck's sakes, because it's going to hit that 45. And look, you got to slide the shit around. That's what makes this not friendly for day trading quickly, because then I gotta go review and submit the fucking order or what have you. And then I gotta check all these boxes, and it's just not a quick way of trading. Whereas like Thinkorswim has something called Active Trader. It's going to show you actual depth. And you can get time and sales if you've not seen my time and sales video. Because the way these option chains are trading is time and sales. Okay? You can see the time and sales, so you can pull up the 41.65 strike. So I've seen it, but I don't run that platform. I need to. But you can see the time and sales, and you can see the market orders clearing out these limit orders. That's how the option chain goes up and down. Okay, but why is the option chain moving up and down? Okay, well, here's the thing. As the actual physical price where this orange line is, as it's going up and down in the ES, so yes, I know it only trades in 5-point increments, but the ES doesn't trade in 5-point increments. It trades every quarters, right? Like you got 165.0, you got 165.25, 165. I'll just show you. It's easier that way, right? So let's go to the 165. You're way down there, but again, the market's closed, so the prices are off. So 165, 165.25. Look on the right, 165.50. Every time the ES is going up and down a tick, the bid offer is going to start changing on here. So I know it trades in I know it shows 5-point increments here, but again, what you guys got to understand is that's a product. It's like Pfizer or Tesla. Each one of these, you got to think of it like that. But every time the market is going up and down a tick on the ES, these are going to be changing. So if the market goes up, this 42.80 is going to go up. Okay. As the market goes down, that 42.80 is going to get cheaper. So it would look like this. So, okay, here's the 42.80. If the market starts ticking up, it's going to start going up in 10-cent increments. And if the market starts going down, it's going to start going down in 10-cent increments. For every fucking tick, this shit may or may not move, okay? But again, it's because this is its own market, because it does have limit orders hitting and market orders hitting. But as far as arbitrage goes, it's moving with the ES pretty much. Now, it's not going to move perfectly with it tick for tick verbatim, okay? So just keep that in mind. So every time the market is moving up and down, these bid offers are moving as well on every single one of these strike prices, okay? And again, I got to make this very clear. All these numbers up here are their own mini DOM, their own DOM. These numbers up here are not the offers above this 45 even. Yes, I know it looks that way, but for fuck's sakes, I just have been explaining. Okay, so you should get it at this point. Okay, so now that we understand how this works, it works on the put side as well. We're not going to be talking about puts. Puts are their own thing. So you have long call, short call. That'll be on the left side. You have long call, short put. I said we ain't going to talk about it. We're not. But just so you know, those are the two different sides. And this orange line says ITM. That means in the money, in the money. So any strike price below 165, again, this is upside down. They're saying these prices are in the money. This orange line is at the money, and this anything down here is in the money on the put side. On the call side, this is out of the money, at the money, in the money. Don't worry about it. It doesn't matter. But over here, out of the money, at the money, in the money. See how it's like a gray shaded box here, and then it's orange, and then it's dark black. You can kind of, you know how the DOM is staggered and shit. That's kind of what's happening. See how the DOM is staggered between these two prices? Same sort of thing. Okay. Now, let's talk about why these things expire fucking worthless. They go to zero. So let's say we want to buy 42 fucking 80. All right? And we're buying it, and it has 10 days till expiration. All right? So let me pull up this fucking calculator. So we're buying it for $4,280, but we're buying at 42.80. Okay? Whoop. So there's something called time decay. That's what makes options not so good when you buy a call. You remember how everybody got rich buying calls during GameStop? It's because the market moved. But if you buy a call and the market ain't moving, well, that ain't good, because this you got to outpace time decay, which we're gonna take. We're gonna get a good visual of it, babies. Okay, just calm down. Okay, so we got 10 days. All right, we bought it at 42.80. Okay, now let's go to 9 days till expiration. Wait a second, now it's worth only 41. At that same strike price, it's only worth 41.20. Okay, assuming the market doesn't move, and the next day, I bought it for 42.80. Now it's only worth 41.20. Oh shit! So subtract that 41.20. Well, fuck, I'm down $160 fucking dollars. If the market didn't move the next day, or it could move, but if it comes back to the price of 165, like if the market is currently trading the price of 165, it can move the next day, but if it comes back and it's at 165 the next day or two or whatever, well, fuck, now I'm down 160. Oh, okay, well, fuck. So let's see what happens. Let's go to another day. Let's go to 6 days till expiration. So this is several more fucking days. Remember, we bought it at 42.80, right? So 42.80. Now we're at the 165. Now it's only worth 38.60. What the fuck? What? So 38.60 minus 42.80. Now we're down $4.20 times 100. We're down $420. Remember, we bought it at 42.80. Now that bid is down. But to be fair with you, we would be selling. So we would be selling at 40.60. So, but you can see how the bid is going down. So we're not going to buy to get in, right? We would hypothetically be selling at that 40.60. So again, we bought at 42.80 minus 40.60. We would be losing $220. But as you can, now we're going to keep looking at this 65 strike on this side. So let's go to 2 days till expiration. 12.70. Wait a second. Oh, well, this is off. Why is this going up? Oh my God, I just figured it out. You can make the option chain go the right way. Oh my God. I can make the prices go higher. Oh my God. Oh my God. Oh, I got a headache. Oh, fuck. I'm gonna flip it. I'm gonna keep it upside down because that's how I know it now. But look, you can hit that arrow and it goes the right way. Oh my God. Well, for the sake of doing this. So now we're at 1560, you know, with 2 days till expiration. So let's assume, let's assume the market moved for several days, but then it comes back to 165. We bought a call at 42 fucking 80. Now we're gonna try to sell it at 1770. Ah, shit. I just lost 2,500 fucking, wait. No, that's not right. 42. It is right. Oh my God, that's a lot of money, boys. We lost 25.10. We lost $2,500 buying at 42.80 and then selling at 1770. Time decay. So what happens is all of these bid-in offers eventually go to zero. all of these bid and offers you see, that's what's happening. So your mini dom, it's like the price is going to zero. Okay. It's like this price. It's like trading a dom, but the price overall, the entire dom is just sinking down to zero. And when you buy an expiration date, 10 days, well, it's 10 days until it goes to zero. Now, there's an exception to that. We'll talk about that later. But for the most part, it's going to zero. Okay, guys? So there's an easier way to take a look at this. And that's what we're going to do. Okay, guys, I'm going to interrupt the video. This is going to be somewhat of a janky edit, but today I decided to actually take an option trade so you could see what the market looks like when it's open and what these bid and offers are doing. I wanted to take a sound trading decision, so I did a long put, which we haven't been talking about in this video, but basically I'm betting the market goes down. It's like a traditional short, so we're going to be on the other side of the option chain over here on the right, but the way it works is very similar to the way the call side works. We're just on the other side of the option chain. Now, what I wanted to do was put up an actual ES E-mini DOM, so that way you guys can see how the option chain is moving with the ticks in the ES. This is actually SPY. This is not SPX. So the price on SPY is going to be a bit different. But we're going to talk more about stuff later in the video. But for now, let's go ahead and look at this trade. So what I'm doing is I'm going to be joining the limit right here. At $3 and maybe, we'll see. There you go. I'm trying to join the bid at $3.23. So it's going through. So now I'm in the queue and then it gets filled. So I got filled at 323. Notice how the price went to 321. So what happened was the market went down some. Hypothetically, the market went up, right? It went up on the ES. But again, on the option, I'm betting the market goes down. So these prices are going to go up as the market goes down. So as the ES went up, this is why I got filled. Again, a long put is like a traditional short on the DOM. Now watch how this thing works tick for tick. So it's at 321 as the market is at 00. So 321 bid by 323. Now it's at 3. Yep, still there. Now, as the ES starts to go down, you're going to see this. You're going to see these numbers get bigger. Notice, so that in the money line dropped because the market is still rallying. So the actual SPY is moving to a whole nother price. We're at 4,200s in the ES. Again, SPY and ES are the same thing, kind of. Different products, but they're tracking the same thing. So we're at 319. So I'm checking to see what happened on the fill. Because I actually took a trade and then got in and out, and it was just all a big fuck up because I put an order in wrong and I wasn't recording. So now I'm attempting to do this for education for you guys. And this is a real trade. You can't do simulator option trades on Tastyworks. You can do it on Thinkorswim, but the simulation is real fucked up because you get insta-filled on queues. On limit orders, so it's not a good quality simulator for options, unfortunately. So notice these prices are going up. Watch the ES is going to dump, and then you're going to see these prices start to go up. So what you guys can't see is what I'm going to do at some point is look to get out of the trade right here. I'll move my body out of the way so you can see that when that time comes. Watch the ES. It's still kind of floating here, so the bid offer is staying the same. Now, one thing you guys got to know is if again, these bid offers will change over theta decay or time decay. And then the option market also puts in implied volatility. So the bid offers also are moving based off of implied volatility. But for the most part, they are at this point moving with the market. So I fast forward a bit. It should dump here. Any fucking day now. I know it's taking a while, but I think it's important you guys watch it. Now watch the bid offer on this shit change. You can see it says 320 in the bottom. Here we go. So now I'm going to be raising the limit to where I want to get filled. Because I'm not exactly sure where it's going to go. That's kind of, it makes it a little weird. Like, where's the bid offer going to be when ES gets to a certain place on the chart? It's going to dump more here in just a second. As soon as it gets to this liquidity at 98.50 on the ES. But watch this. I'm going to lock in a limit right here where my finger is. I believe I get out at $3.30 and I buy it at $3.23. So I'm going to make a couple of bucks. Right now I would only make $1 on it if I try to limit out. Now there's an opportunity for a break even or a dollar win. Now it's a break even. So you can see it's the same thing almost. Should be breaking at any point. Here we go. Right there, the offer's at $3.29. So I'm going to lock in a $3.30 offer. You can see I had to like check all this shit to confirm the order, which sucks. And then I lock in the offer. And then the order's about, there's the fill. Okay, so we made $6 on that a fucking options trade. Whereas, you know, I got in roughly around this 99.25. Hell, on a one lot, that would have been 1, 2. So that's $100 on a one lot in the ESE minis, where I'm only making $6 fucking dollars in the options with one contract, and it's more of a pain in the ass to execute. So in my opinion, options really, they do have their place. I think it's going to be more neutral option income strategies. But we're not talking about that in this video per se. And anyways, now we're going to go ahead and get back to the rest of the video. Again, I'm filming this section on a different day. So we're going to get back to the video that I filmed on a prior day. So that's why I said this would be a janky edit, but I wanted you guys to see what that actually looked like. So let's go to the 10-day on SPY. It's a lot fucking cheaper. Again, let's buy the 44.15, okay? Again, this is why I was using SPX, because the numbers in SPY are different, even though it's still tracking the S&P 500 or ES, whatever. So there's the bid offer spread, 468 versus 472, but instead of us spending thousands of dollars. Now we're spending $470. Okay, but this is currently where the market is trading. So see this 470 out? It says minus 470 down here. And then it's 470 here. Again, that's what we submit our limit order buy at. Well, the thing with options is when you buy in options, when you buy a call, you'll never lose more than what you paid for it. Seems like a great idea because when you trade futures, you could just keep losing if you don't have a stop loss, right? Oh, I could just lose 470. Oh, that's great. It's like a stop loss for you. Okay, that seems like it's a great fucking idea, right? So here's the deal. Assuming we buy it now. Assuming we buy it right now, it's going to immediately make us money as soon as the market goes up. And it's immediately going to start losing money as the market goes down. But remember I said this thing has 10 days till expiration? Well, here's the problem. Not only do you need the market to move in your favor, but you also needed to do it kind of quickly because as time starts to decay, we already looked at the bids and offers over time. They start to become worth less and less. Look, it's 468 right here. And that's 10 days, right? Same thing. We'll go to a 5-day. Now it's 382. And then 2 days. Now it's at 190 or 131. So again, it is progressively going down. And this is what it looks like. So if I buy it now, it would hypothetically be where this blue line is. I don't know why it's so off. But hypothetically, we would be right here. We would immediately start making money every time it goes up. And then we would immediately start losing money. Now notice the graph over here has this hard triangular look. It like almost just steadily goes up. That's to be expected when you buy like futures. But over here, it kind of starts to have more of this tapery look. Well, see, here's what happens if as the market goes every day. Again, we're buying this at what, 415? Yeah. So we're buying at 415, which is right back here. This is off. This is off. The market's closing. It's the fucking weekend, so it's off. Our break even is where this blue line is. But anyways, as the market goes. So actually, let me just draw this real quick. So that little circle right there is where we're in right here. Okay, it's been an extra day, so there's time decay. This is off. But if we bought it on Friday or whatever, it would be where that circle is. It's going to be a little off, but you'll get the idea. Now, as time is going on, that was our break-even point. Put it back. This is our break-even point. Like, as soon as the market moves up or down, we're either making money. But as time goes on, our break-even point starts to move upward. Every day, right here, May 2nd, at 12 a.m., May 3rd, 4:39 a.m., as every hour ticks, that break-even is slowly moving up. And that's assuming the price doesn't move. That's assuming the price stays exactly where the fuck it is. And Spire ES is trading in the exact same bid offer. Obviously, it's going to be moving up and down. And you could either be immediately in the money or out of the money. But let's just assume the market's not moving. Every day, your break even is now over here. Look. So right here, you're making 17 fucking cents or break even, right? So let me draw a little circle. And this would be May 5th. Okay, and I have 5 days remaining on this fucking thing. Remember, it's a 10-day expiration. Okay, so let's put that circle there. Drag it back. So right here, so if it went up to this price, if the market moves to this price of 418.51 or whatever, because again, it's SPY, so the number's different. If it goes up to the price of $418.51, the day we buy the option, well, at this point, we would be up $139 if we sold right here on the first day. But if we wait several more days and the market goes up, well, now it's break even. Every day that break even is moving away from you, which is not good. Every day. Now with 7 hours remaining before it expires, now if you was to sell at that same place and assuming the market didn't move, now you're losing $117 fucking dollars. And then boom, here you fucking go. This is what it looks like on expiration. So let's talk about this. So here's expiration. Here's our break even, right? Let's go back to the day we bought it. Whoop. Okay, our break even is here. If the market immediately moves up and it goes to this, and the market is actually physically trading at the price of $419.72, we would make $223.24 on our option contract. But it might not. The market might start going down. It could go up. It could go not as high. It could go wherever. It could be moving up and down like this. Because let's face it, the market chops back and forth like this. But on our expiration, at that same price, we're break even, pretty much. If it goes to this price the day we bought it, it's worth $221. But if it goes to that price the day of expiration, or break even. So in order for us to make any money, it needs to be above this strike price of $419.71. So about $420. Hey, it needs to be above the price of $420 essentially to make any fucking money. So it's not going to necessarily expire worthless per se. That DOM is gonna, those DOM numbers, those numbers on the option chain are constantly going to zero. These are constantly going to zero. Now, there are going to be prices when you're far enough away from the current market that will actually yield a couple of bucks. But for the most part, it's all going to zero. So, look. So you can make money here. So at the 421 right down here, the 421 strike, if the market expires at the at the price of 421, okay? No, I'm sorry. If the market closes at 416, the market didn't fucking move. If the market doesn't move, you know, we're gonna lose. We're actually gonna lose a max of 470. Because again, this is off. Do you see how this curve kind of like has a hard angle right here? This is going to be where we hypothetically bought the strike. It's so off because the market is closed. But we're gonna be losing a max of 470. Now, there could be a point where the market closes in one of these places, and then you're going to make, you know, you're going to lose less. There's this weird zone of where you're going to make less. If the market is closing at 423 or what have you, you're going to make, you know, $318 versus, you know, on the day, of, if it goes there, you're going to make a lot more fucking money. You're going to make 467 versus, you know, 330 if the market was to get to that 423 price on expiration. So yeah, you got limited downside risk, but you got to beat the clock. So when you buy a call, what you're wanting to do is you want the market to essentially move right away. It needs to work almost right away. Because these things pretty much go to zero. Again, if SPY is physically trading at 423 and closes there on the day of expiration, you're gonna make, you know, $340 fucking dollars if you don't pull your profits. You can get in and out of these things at any fucking time, right? You don't have to wait for expiration to get out of these things. I can submit an order and get out at the price of 423 if the market goes there. and make 474 bucks. Obviously, that's going to be changing because of implied volatility, which I'm not going to go over. But let's look at the other side of the trade because there's somebody on the other side of the fucking trade. Now we know what happens when we buy a call. But there's somebody on the other side of the fucking trade. Okay, we could be on the other side of a call. We could be a short call. The way a short call works is a lot different than the way the long call works, okay? So, as we saw, a long call looks like buying a normal futures contract. The only difference is our downside is limited to a max loss of 470, where our upside, we can make an infinity amount of fucking money, right? But we gotta outpace fucking time decay, right? So let's take a look at the other side. Okay, here we go, boys. Hypothetically, this is where the little circle is where we would be getting into these things. I know my big fat fucking head is in the way, so let me move this up. All right. So this is the long call side, right? Remember, it will expire and it will look like this. Remember? Oh, I gotta redo those little circles. By the way, guys, if you're entertained and you love what I fucking do, consider donating to the coffee because this fucking YouTube channel don't make shit. This is a full-time, it's not a full-time gig. But, you know, if you appreciate the rich material I'm giving you guys, please consider donating. I would love it. It would be nice. Because I really ain't motivated to do these videos sometimes, but I have passion for making content, baby. But anyways, let's take a look at this. Remember, this is if we buy the long call. If it moves today, that's good. We need it to move today. That's why everybody made so much money on fucking long calls during GameStop, because it was moving. If the market is dead as fuck, you're gonna get in trouble, right? Again, this is what it looks like. We bought here, and every fucking day, if the market ain't moving, now the market could keep moving up and down every fucking day, right? It could be doing this, doing this, doing this. But at the same time, it's doing this, it's doing this, it's doing this, but it's doing this, it's doing this, it's doing this, but it's doing this, it's doing this, it's doing this, it's doing this, and it's doing this, it's doing this. So, do you see? And then I can get out anywhere when it does this. I can get out anywhere when it's going up and down like this. But every fucking day, it's going that way. It's going that way, motherfuckers. And then boom. Right? So, somebody's on the other side of this trade. And it looks a little different. Okay? So, options is like, insurance. You know what insurance is, right? You drive a car, you have insurance. You own a home, you have insurance. You fucking have a meat suit body, you needed to go to the doctors, you probably have insurance, okay? Right? Let's say I own a fucking home, okay? And I only want to buy insurance for 10 fucking days. All right. It's going to cost me, you know, let's just say it costs me $470 to insure my home for 10 days, all right? But if I want to insure my home for fucking a year, so let's say about 334 days, well, now it's going to cost me $3,667. It makes sense, right? The longer you buy insurance for, the more it's going to cost. You buy insurance for a day, it ain't going to cost as much as it's going to cost for a week. It's not going to cost as much as it would for a year. It just makes sense, though, because the insurance company, well, they're betting on you. They're betting on your fucking house not to burn down. They're betting on a tornado not ripping the goddamn thing right off the foundations, right? So the longer you buy an insurance policy for, the more likely the tornado could rip the house out of the fucking foundation. Whereas if I know it's not tornado season and you're like, hey, fat cat, I need to buy insurance for a week. Well, it's going to be cheaper because the likelihood of a tornado coming in a week is not there. But versus a year, well, there's a lot of uncertainty. It could happen in a year. There might be tornado season. So naturally, when I sell you insurance, it's going to cost fucking more for a longer time. So and that's the thing, as you go higher up in days, let's go to 365 days. Jesus Christ, that's $6,300 fucking dollars, right? Right? Whereas if I buy insurance for 2 days, it's only 51 cents. It's 51 fucking dollars. Okay, on the left again, remember if we buy this thing, it works out immediately in our favor. And on the long call side, we're trying to beat time decay. We want the market to move up. There's somebody else on the other side. So notice these graphs are like the same fucking thing. They're just flipped. This triangle is on the upside, but on the other side, on the short call side, it's upside down. And it's red. But notice how it's green and it's tapered on the left, but over here it's upside down. It's the same shit, it's just flipped. And then the colors flip as well. So somebody else is on the other fucking side. So if you're on the other side and you're doing a short call, you're the insurance company and time decay is your fucking friend. Whereas if you're on the long call side, time decay is not good. So let's say we bought it right here and we're just a short call. And the market isn't moving. Well, if the market's not moving, but as the passage of time goes by, notice how we're actually starting to make money. We're starting to make money where that little circle is. Look at that. If the market don't move, that's fine. Because we're the insurance company. Now, if the market moves up, that ain't good. But if the market moves down immediately in our favor, even better. But if the market doesn't move, that's okay. And then all of a sudden, boom. There we go. Now again, this circle is off because there's already time decay because it's Saturday. Hypothetically, where this hump is, where this like slope is up here, that's hypothetically our break-even point. That's where we would have got in because we're buying a 415 call. So it's right here. So hypothetically, we're already making money. So let's kind of fix that. I don't know why it's so off. Remember, now I fixed the circles. Remember, we're buying the 415 call. Remember, that's like ES. But since it's Saturday at 4:04 p.m., time is decaying. So if the market ain't moved, well, fuck. Your long call is already starting to lose money. And then when it opens on Monday, you're going to need it to move even fucking further. So when you buy these fucking short-dated calls, you should probably not, like, buy it going into Friday. Probably not a good idea. So you may want to get a little more insurance, a little more premium, a longer dated call. I'm just saying from my perspective. Now, there's a way I use these fucking things, which I'll talk about later. But if you bought the 415, sold the 415 call right now, you're making some money. But again, as time decays, boom. Now, we're going to make a max of $470. Whereas on the long call side, you're going to lose a maximum of $470 at expiration if the market doesn't move. Remember, on the 415 long call side, at expiration, it better be above the price of $419.69. Whereas if it's below that price over here, $419.70, that's when we start to lose money on the short call side. So, again, we bought it over here, and as time decays, the insurance guy's making money. He's making money as time fucking decays over here. So, but on the insurance side, you're never going to make more than $470. You're never going to make more than $470 at all. Yeah, it's nice if the market moves down in your favor immediately, so take a look at this. Now, if the market on day one moves into your favor, it'll never make you more than $463. in order to squeeze the maximum amount of money on the short call side, it has to expire at 470, right? There's a point where it's not going to make you more money. Well, it does. It makes you little pennies at some point. See how this graph slopes and it's like this really hard curve versus like over here on the long call side where if it immediately starts working, it's making you money. And again, this is day one. As soon as we put these contracts on, it starts the curve. But again, on expiration, that's what it starts to look like, up right at expiration. So this shit is getting drugged backwards and backwards, and you're making more and more and more money on the insurance guy. Because as we get closer to expiration, the likelihood of things getting fucked up is becoming less and less as time decays. So that's why that curve is sort of getting drugged backwards. But notice how your loss is going to be pretty fucked up. If we hit this, like Friday, we hit this crazy bull run. If we just hit this insane bull run where the market just goes up and up for 2 fucking days, you're getting in a lot of trouble on the insurance side. So therefore, in order to put on a short call, it's called a naked call or a naked put. If you're doing the put side, we'll talk about puts in a minute. But if you're putting on a naked call, you're basically shorting the call. Again, this is a long call. This is a short call. The short call, you're kind of you're betting for the position to move down. You're betting the market moves down or it doesn't move at all to collect premium. Okay? So again, this has its own downsides because you could lose an unlimited amount of money. Time decay is your friend. But since it's a naked call or a short call or you're writing a call, anything. So when people are saying write a call or naked call, they're talking about this graph on the right. It's a short call, okay? It's going to look like this. So since it has potential unlimited loss, your broker requires you to have a massive amount of fucking margin to trade this. So if you want to trade just a short call by itself and not hedge your option position with something else like an iron condor or whatever, they're going to require you to have a fuckload of fucking margin. Now, there's ways to be the insurance guy and collect premium and not need a lot of margin by putting on like a spread. If you guys are interested in how spreads work, I can show you in a different video, but I'm just simply not going to do it in this one because this video's gone long enough. But anyways, that's what that looks like. Now let's take a look at the actual, like a put. So just take a look at this. This is what the long call on the left looks like, right? Long call over here. That's what it looks like on expiration. Short call. That's what that looks like on expiration. Now let's take a look at a fucking put. So here is buying a put. So buying a put is like when you're trading the ES, it's no different than just shorting. So buying a put is like trying to short the market on the red side. You want to bet it goes down. Buying a call on the ES is like going long. It's the same thing. So when I buy a put, I know that seems confusing because we looked at a short call. When I'm buying a put, I'm betting the market goes down, and it looks much like the long call side. It's a long put, but again, this is the land of backwards. I want the market to go down. But much like the long call, the long put, I only lose a maximum of 310 according to this. Let's take a look at the option chain. So I would actually be getting in on this side, and you would want to buy it because this is, again, the put side. So what's the mid price? $309. $310. So they're saying $310, whatever, close enough, right? So the most I'm going to lose, because that, remember, the bid offers on the option chain, whatever you're locking in as your buy price, that's what you're going to lose a maximum of, unless you're the insurance guy. So just like the long call, the long put, we want the market to go down immediately. But again, you know, let's say we're in right here, and this is a 10-day expiration. As time ticks, you know, the market could be moving up and down like this. The market could be chopping. As time decays, the market is chopping. You better hope it fucking moves in your favor. And that's the thing. When I put on a long call or a long put, I'm doing it in a place where I think the market is going to move immediately. That's the way I use these things. You don't want to put this shit on if you don't think the market is going to move, in my opinion. But I trade this shit differently because I'm an outright futures trader who has a lot of experience doing this. Whereas your option nerds who you're watching on YouTube, half of them don't even look at fucking charts. So they don't really fucking know what's happening as far as charting goes and finding, you know, where potential runs could be and all that shit. I like to use long calls or long puts when I think there could be a swing trade, when I think there could be a trade that's going to move in my favor in the next day or two. But I don't want to risk doing it on a futures account where I might take on, where I might have to run a big stop or I might get stopped out a lot. Whereas if I put on a long call, long put, I have that downside hedge, right? I'm only going to lose, $400, $300 on these things maximum at expiration. But again, the reason I'm putting it on is I'm betting that the market's going to move like immediately. And if it doesn't and it takes a little bit longer to move than I expected, well, instead of taking a max loss, I'll just cut the fucking position for a smaller loss or a break even or some shit. So that's the way I kind of do it. But anyways, again, as the market is decaying, this shit is happening like this. The market is chopping. So therefore, your break even keeps going further and further away from you up until the point it looks like this. Now, again, somebody's on the other side of this fucking trade. So here's the other side of the trade. Here's what happens when you sell a put. You're the insurance guy. It's the same fucking graph, but it's just switched the other fucking way around. That's it. So now we saw what a long put and a long call looks like. You're betting. Long put, we're betting that the market goes down like a traditional short in the ES, whereas a long call, we're betting the market goes up. But the problem with both of those is time decay. We're going to lose a maximum. We can't lose more than what we paid for it. And we have the ability to make a lot of money. So here we go. Now on this side on the right, again, this is the short call, short put. So hypothetically, a short put, you're betting the market goes up. Long call, you're betting the market goes up. The difference between the long call and the short put is I can only make a maximum amount of money if the market goes up. So let's take a look at that. So here's the long call on expiration. I'm betting the market goes up, can only lose a maximum amount of money, I can make unlimited money. Where a short put, I also am betting on the market going up, but I'm the insurance guy, and I can only collect a maximum of $348. That's it. Where the long call, it goes up. So this is where it gets short put, up. Long call, you betting it goes up. Long put, I bet it goes down. Short call, I bet it goes down. But I'm the insurance guy on the short call side, where I'm just outright betting and trying to outpace that time decay on the long put side. Okay? So, long put, market go down. Short call, market goes down, but I'm the insurance guy. Long call, market goes up. Short put, market goes up, but I'm the insurance guy. So when you're watching these option videos and you hear somebody say short put or short call, you're the insurance guy. You got to think of it like that. Whereas long call, long put, you're betting on an outright direction and you're not the insurance guy, and time decay is not your friend. That's how these fucking things work. And then what you can do is you can buy multiples of them Look, you can buy multiples of these. These are all puts, but you can put on a bunch of them, and depending on where you put them, you can like, this is an iron condor, so you can make an iron condor, and it looks like this with the puts, and that's 4 different positions and 4 different strikes. And the reason it looks like that on expiration is because of those bid offers and how they're going to expire over time. Because on day 1, it looks like this, and then as it gets closer to expiration, it looks like that. There you go. So this is what it looks like the day you get it. And then boom. Or you can do the same strategy with calls. Again, it's just the way it's sort of, it's the way you construct these. It's the way the bids and offers are on the actual option chain that make it look like this on expiration, because what's happening is you're hedging a bunch of shit out. So that's how fucking options work. The option, and it all has to do with these bid offers. It's the way these bid offers are moving. It's the way the price is moving when the bid offer is moving. It's all about the bid offer. They're all going to eventually go to zero to some degree, because obviously we saw what the long calls look like on expiration. If it's above a certain price, you're going to make money. But for the most part, if the market ain't moving, it's going to zero, and that ain't good, right? So that's how these fucking things work. I hope this was a good video. I hope it was helpful. Please like and subscribe. If you want to know more about, I can go over like credit spreads if you guys want to know about that and how that works. Probably be a shorter video, but what I'll do is I'll show you on the option chain how that works and how you can leg into them and get a better fucking credit. So anyways, guys, like I said, I like to do these. I like to do long calls or short or long puts. See, I get confused. When I know the market is going to move and I'm going to swing trade and I don't want to risk it in the ES. I'm going to be getting more deeper into options in my personal trading at some point. But there's been no videos out there that have explained it and why it's doing what it does, because nobody explains the option chain. And as an order flow trader, I'm like, wait a second, this shit makes sense. So, guys, I will see you in the next video.